The return-stacked bonds and managed futures ETF seeks long-term capital appreciation with an aim to provide investors with an efficient exposure to a broad U.S. bond basket while stacking a managed futures strategy on top. In other words, for every dollar invested, the ETF will aim to simultaneously provide a full dollar of broad U.S. bond exposure and another full dollar to a managed futures trading strategy. The bond security portion of the strategy will be sub-advised by Newfound Research, while Resolve will be the trading advisor for the managed futures trend strategy, which invests in 27 highly liquid exchange-traded futures among 4 asset classes: commodities, currencies, equities, and fixed income. While the managed futures category has historically exhibited very low correlation to both stocks and bonds while achieving a competitive rate of return over a full market cycle. So for example, if you look at the SocGen CTA index, what you'll find is that it has 2 very important characteristics. Number 1, it has historically provided positive returns during prolonged multi-year bear markets. And number 2, it has historically exhibited inflation hedging characteristics. Now today, we continue to see challenges for traditional portfolios. Given the ongoing geopolitical turmoil, an uncertain rate environment, stretched equity valuations, and rising inflation volatility, all of these imply depressed returns and higher potential volatility for traditional portfolios. Now, we believe that a thoughtful allocation to managed futures can help investors navigate this environment in a much more robust manner. When allocating to managed futures, one of the greatest challenges investors face is how do I make room in my portfolio? Particularly during a decade like the 2010s, when equities and bonds were soaring and managed futures returns were eking out single-digit returns. RSBT seeks to solve this problem by allowing investors to pursue diversification without sacrificing core stock and bond exposure. So how do we do this? Well, as explained earlier, the ETF targets $2 of exposure for $1 of investment, half in bonds and the other half in managed futures. By replacing a portion of your bond holdings with RSBT, investors can seek to maintain their bond exposure while stacking managed futures on top. In other words, you're not sacrificing your base asset allocation at all. You are merely adding a new, additional diversifier in the commensurate non-correlated returns that come with it over time. Even during the 2010 period of middling managed futures returns, as a stack, the extra return would have been a welcome addition. No more compromises. We are taking a yes-and approach to portfolio construction. We believe return-stacked ETFs will ultimately help minimize fear of missing out while possibly enhancing returns to portfolios, all the while managing risk better to thrive in the challenging markets ahead.